So you are overweight China,
Thanks.
Taiwan and select ASEAN markets. Does that imply that we're going to be okay, or we can take a tightening cycle at the Fed?
It basically does, in a single word, although I don't want to sound as though we're complacent or ignoring the risks of a tightening cycle, which of course are always headwinds for equity markets. I guess our argument is that Asia broadly, and I think China in particular, has effectively pre-traded some of this. You know, in China's case, it's obviously was catalyzed last year by the tightening of regulatory policy, but the effect has been to have a 20-25% compression in forward valuations to levels that are quite inexpensive. China's trading about 12 times earnings right now compared to the low 20s for the United States market. And on top of that, China is in a completely different policy cycle than the United States, where policy is easing, and there's lots of evidence that's already begun, not just on the monetary front, but on fiscal and also select areas in property and in credit extension. So we think there are a lot of China-specific issues that will be supportive for it at a different starting point. And all that suggests that we may be able to weather this tightening cycle in the U.S. much better than has previously been the case in past cycles.
I noticed you said select ASEAN markets. Just how vulnerable is Indonesia in this context of Fed tightening? And if I can also extend it broadly to the region, what about India?
No, a great question, Sri. And if you look at the historical evidence, ASEAN markets, particularly Indonesia and also Thailand and Malaysia, tend to be more sensitive to changes in U.S. rates, and in particular, increases in their own long rates. And I think the narrative that supports that is there typically tends to be a carry trade between overseas investors and higher yielding domestic ASEAN markets. And to the extent that you start to get higher offshore rates, then that can pressure the attraction of the onshore carry trade, and that can lead to some pressure on the currency, and that can flow through to the equity markets. That's sort of the the narrative that supports that empirical evidence. Again, we would note that given the underperformance of these markets and also a number of additional positive dynamics that really led us to upgrade our view, just very quickly, we're looking at a recovery, an acceleration in growth, that sort of delayed recovery from the COVID hit, both from an economic and earnings standpoint. So that's number one. Number two, the ASEAN markets tend to be heavy in the banks. And of course, as the rate cycle turns, banks tend to have a tailwind rather than a headwind. And then number three, we're starting to see the emergence of the digital economy in the ASEAN markets. So that's the reason why we upgraded Singapore and Indonesia. There is a near-term concern that there could be some challenge from the tightening of the U.S. rate cycle. I guess our view is that with some of that being well priced and anticipated in the market, that the surprise and the shock factor of the market compared to, say, the taper tantrum that we saw in 2013 and the tightening cycle in 2018, we think the impact on the market this time may be somewhat more subdued than previous times.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.